Hello everyone, I hope so you will be fine. So today we are going to discuss one more topic, and this topic is relevant to your corporate finance section. Okay, and we know the corporate finance section is 20% of your exam. So here we go, and the topic name is portfolio management we are discussing. So let's understand first what is the meaning of portfolio, and then we'll see what is the efficient portfolio. So guys, portfolio means simply a portfolio is a collection of financial investments. Like for example, if you are an investor, so you may invest in the stock, bonds, or commodities, or even exchange traded funds like futures, option contract, these kind of things. So as an investor, if you are investing, let's assume in the stock or bonds of different company. For example, you have investment in company A also, you have investment in company B also, you have investment in company C, D, and so on. So this all the collection of financial investments or all the combination of investments is called your portfolio. Because normally in companies we have treasury department, so usually they are also doing some investments into the stock bonds of the other companies. Okay, so if we are having combination of different investments, so that is called your portfolio. So now what is the efficient portfolio? So guys, as an investor, obviously what we want maximum return, right? We want to maximize the return, but we also want to minimize the risk at the same time. Okay, this is what is the wish of the investor. Now, which portfolio or which combination of investments will be considered as efficient or feasible? So simply these 2 points you have to remember. So the portfolio will become efficient if you are getting highest expected return for given risk. So simply, like, your return is maximum. Okay, let's assume if your risk is at this level, but at this level you are getting highest return. So that is your efficient portfolio. So same statement we can say this way also, or the least risk for a given expected return. Okay, like for example, our risk is minimum but our return is highest. So if this is the situation, then you are generating highest expected return but at the lower risk or at the least risk, so that portfolio is your efficient portfolio. Now guys, please remember, so being investor, whenever you are trying to invest, so in the bonds or the stocks or in even in the commodities or even in the exchange traded securities, so please remember, we have to make some important decisions. Like for example, first we will decide how much amount we want to invest, right? So second thing, we can also decide in which securities we want to invest. Maybe you want to invest in the stocks or the bonds or maybe into the commodities, right? Third thing you also need to consider, like how much is the expected net cash flows you will generate from that investment. And fourth thing, obviously you will also consider what is the risk associated with that level of investment, right? So fifth factor you can also consider the maturity of funds. Maturity of funds means the amount which you are investing today, so when you will get it back. Obviously if you will get it back at the needed time, so then it is good, right? For example, maybe you need your money back after 3 years, maybe you have to erect a new factory, or maybe you have to make certain repayments. So whatever investment you are making, so you have to make sure you will get that money back at the needed time. Understood? So then, this is what these are the normal relevant factors. Other factors you may also consider. You may also consider the securities marketability. Marketability means say how easy it is for you to sell those investments, right? So I also told you, you will also consider the market risk. Market risk I have explained in the last class, like which was your systematic risk, right? So, but simply here, if you don't know the market risk, you should remember the risk, right? All these factors we will consider while we are investing into the stocks or the bonds or into the commodities. Okay. So now guys, please, here we have here, now we are discussing. how to measure the risk related to the investment. So first, what is the risk? So here we have definition. So actually risk is what? So risk is the chance means it's a likelihood, it is a probability that the actual return on investment will differ from the expected return. For example, maybe you are investing into the stock and you are expecting that you will generate 10% return on your investment. Okay, this is what is your expectation, but actually what you may get, actually you may get maybe 15%. So then if your actual return is greater than expected return, this is not the risk. But if your actual return is less than expected, for example, you were expecting that you will generate 10% return, but actually let's assume you have generated, let's assume, only 5% return. So now this is the risky situation, when your actual return is less than the expected return. Because being a finance manager or being a finance person, so you have to consider always risk is always the worst side. So the worst side here is when your actual return will be less than the expected return. Now here, actual return we don't need to calculate here, but here we have some calculations for expected return. Because when we invest into the stocks or bonds, so we have to take decisions before the investment, not the after investment. So here we go. So what is the expected return? I'm going to explain now, or how it is calculated. So this is, please remember, this is the sign for expected return. This is how expected return is denoted. So we are simply, signs are not important, concept is important. So here we are discussing expected rate of return, how it is calculated. Actually, expected rate of return on an investment is determined using the expected value calculation. If you remember, in the part 1 we studied expected values, so how to calculate. So I'll quickly repeat the calculations also. But when we calculate expected rate of return, simply we need expected values calculation we need. Okay, so what is expected value? Here is the definition for expected value, although we studied in the part 1 also, but slight calculations I'll explain. So please remember, expected value is what? It is the average of possible outcomes weighted according to their probabilities. So we can also simply say this way, it is the summation of what? Possible rate of return multiplied by their probabilities. If you will multiply possible rate of return first with their probability means the chances, right? So if you will multiply the possible rate of return with the probability, right, so you will get the average value. And obviously, once you will make the summation of all these possible values, once you multiply with the probability, so the summation is called what? Expected rate of return. Okay, so simply what you have to do, first you need to identify from the question what is the possible rate of return. Second thing, you need to identify what is the probability for each possible rate of return. So then once you will multiply, you will get the value. Understood? And for example, maybe your possible rate of return could be 10%. For 10% probability could be 40%. So once you will multiply 10 times 40, you will get one value here. Maybe another possible rate of return is what? Maybe there could be a 20% profit, but for 20% profit probability is 60%. Once you will multiply 20% with the 60%, you will get another value. So if these two values you will add, so this is what is called your expected rate of return. Understood? So let me give you a small calculation figures. So how to calculate expected rate of return. So this is how similar MCQs can also be given in your exam, where he will ask you to calculate just expected rate of return. So here we go. Here we have example for expected rate of return. Okay. So please remember, a company, let's assume, is considering investing in the common stock of one of the two firms. So you have actually two options to invest. So one, you can invest in the X company, X corporation, and second, you can invest in the Y corporation. So two companies you have to invest. So the expected rate of return on two securities based on their data, this is how we will calculate. And this information will be given in the question, whatever I am highlighting now. Please remember, first we are working with the X company. And for X company, in your exam question, he will tell you rate of return percentage. Rate of return. So please remember, this rate of return is your possible. rate of return. Possible. For example, maybe if you will invest into company A, so maybe 80% return you may get. Okay. Or you may also get a 50% loss because 50% is negatively written, right? So it means it's a loss. But for 80% return, how much is the probability? Please remember this probability will also be given in the question. Rate of return will also be given in the question. So here we have a two rate of return. We have a 80% profit or we may have 50% loss, right? But for 80% profit, how much is the chance? Which is called probability. So let's assume chances are 60%. So being a student, you don't need to allocate any probability to the rate of return. So it will be given in the question. So we have a probability of 60% that, say in simple words, we have a 60% chance that you will generate 80% return. Then for 50% loss, that you will incur 50% loss, for that chances are how much? 40%. So please remember, so this information will be given. So rate of return will be given and what probability will be given. Now the point is how you will calculate the weighted average value. Weighted, this is what you have to calculate. So simply you will take rate of return, which is possible rate of return 80%, multiply by probability is 60%. So you will get the value 48% as a weighted average value. And then the 50% loss, you will multiply with their its own probability, which is 40%. So if you will multiply 50 times 40%, so you will get 20% loss figure, weighted average figure. Now guys, what you will do, so simply if you will make the summation, here I cannot make summation because one is positive value, second is negative value. So I have to net off. So 48 is positive, 20 is negative. So remaining figure is 28%. So this 28% is called expected rate of return. And you can see this is the summation of weighted average value. Summation of weighted average value. And weighted average value, how you got? Possible rate of return multiplied by probabilities. So this is what is written in the definition here. So you will take possible rate of return first, then you will multiply with the probability, you will get answer. So those answers you need to make, you need to add or you need summation for those answers. So this is what is called your expected rate of return. I hope so it is clear, right? Then guys, it means if you will invest into company A, so what is the expected rate of return? Expected rate of return is 28%. Okay, expected rate of return. So similar way, we have a let's assume data for company Y. Let's assume if you will invest into the Y, so these are the possible rate of return percentages and these are their probabilities. For example, and this rate of return percentages and probabilities will be given. For example, let's assume if you will invest into Y corporation, so 30% profit you can make or 10% loss you can incur. If you will make 30% profit, the probability for that is 70%. If you will incur 10% loss, the probability for that is 30%. So these two information will be given in the question. Now simply you have to calculate what? Weighted average figures. And weighted average figures, how you will calculate? Simply we will take first possible rate of return multiply by probabilities. So this is what 21%. Then we have a 10% loss times probability, which is 30%. You got 3% negative. Again, I cannot make summation because one is positive, second is negative. So I have to net off. So net figure is 18%, right? Now, if your investment decision is based on only expected rate of return, so then which is the best option? X is the better. Why? Because X is giving you highest return, right? Highest return, right? So X is better. But on the other hand, Y is giving you only 18% expected rate of return. But guys, we will not take decision only based on expected value. No, we also need to consider the risk associated with these investments and to measure the risk, like how much risk is attached with X corporation and how much risk is attached with the Y corporation. So to measure this risk, we always use the concept of standard deviation. Okay, so now we are going to quantify risk. Okay, or simply quantifying mean to say we are going to calculate the risk and the risk associated with the let's assume individual investments. So we can measure by using the standard deviation concept. Okay, so standard deviation, I'm going to tell you. I'll explain the formula also, how standard deviation is calculated, and then I'll show you simply the calculation figures also. Okay, standard deviations. So actually standard deviations we always use, okay, to quantify the amount of variation. The amount of variation mean to say amount of variation from the average. Okay, let's assume I'm just telling you. First let me explain here what is the standard deviation theoretically, then we'll go to the calculation. Actually standard deviation is the statistical measure. Actually, it's a statistical topic. So, and this concept we always use to quantify, or quantify means to calculate. So, standard deviation actually we use to calculate the amount of variation. Amount of variation means amount of risk. Okay, which is our variation is also called dispersion in a set of data point. In simple words, because we are finance student, we are not statistics students. So in finance, so we always use standard deviation to measure the risk or volatility of an investment's return, like how much return is volatile. Okay, so to measure the risk or the volatility of an investment, actually we are measuring what risk in return, right? What risk you may face in the return, right? Or what variations you may face in the returns. So we always use the standard deviation concept, okay, to measure the risk or volatility of an investment. Understood? So please remember here we have a small example, because first I'm just trying to communicate theoretical concept. So you have to remember standard deviation, what is the use to measure the risk of an investment return. So you are measuring simply risk. Okay. For example, here example is return. For example, if the return of the stock have a high standard deviation, because sometimes standard deviation answer could be higher, sometimes it could be lower. Please remember, if when you calculate the standard deviation, and if answer is higher, it means this is a high risky investment. This is the high risk investment, because there are more chances of variations. Obviously, if your return will vary, if your return is varying, obviously, so it means you are facing more risk, because you may get lower return also, right? So, but if standard deviation answer is lower, we'll calculate standard deviation. So it means we will assume that our risk is lower. But if standard deviation, let's assume these are standard deviations. If answer is higher, so risk is higher. If standard deviation answer is lower, so risk is lower. Another way, if standard deviation answer is higher, it means that investment is more volatile. If standard deviation answer is lower, it means that investment is less volatile. So now just I'm giving you example here. For example, let's say we have a, uh, I'm just giving you another example, just as a layman, you should first understand. For example, let's assume you are having some trees, and average length of the tree is, for example, is 20 meter. I'm just assuming. This is what is the average length. Average length mean to say the mean. The mean, you know the average, right? It's a 20 meter. What if the standard deviation is 2 meter? Let's assume standard deviation is 2 meter. So it means the length of the tree could be now 20 plus 2, like 22 meter, or it could be 20 minus 2, 18 meter. It means it it means, so standard deviation 2 mean to say your return or your length of tree might vary. Okay, might vary from 20 to 22, or from 20 to 18. Understood? For example, if standard deviation is, again I'm assuming, if length of the average tree is 20 meter, but now standard deviation you have calculated, and standard deviation is 4 meter, for example. It means now average length could be 20 plus 4, 24 meter, or it could be 20 minus 4, 16 meter. Right or wrong? And risk is always downside, right? So this is what I'm trying to tell you. So if standard deviation is higher, it means there is more volatility. See the volatility from 16 meter to 24 meter. So it means risk is higher. If standard deviation is lower, so see the volatility from 18 to 22 meter, it means risk is lower. So this is just I gave you example of the tree. So same thing we'll do, right? With the return. So if you can assume these meters as a return, okay, and these are the standard deviations. So same concept you can apply. So here we go. So I told you already what is standard deviation. I told you standard deviation always we as a finance student we always use to measure the risk or the volatility of an investment return. And if standard deviation is higher, it means risk is higher because volatility is higher. And if standard deviation is lower, it means risk is lower because volatility is lower. Volatility means a variations. Okay, now here we have another example, just as an example. Then I'll tell you the standard deviation formula, and then we will quantify the risk of investment. For example, so consider a set of monthly returns on an investment. For example, so this is what is your monthly return, could be 5%, 8%, or it could be a loss of 2%, or it could be a 10%. Okay. So please remember, you would first what we have to do. First, we will calculate the average value, average return, average return, average return. Okay, we will calculate, and then we will use the formula which I will show you for the standard deviation to calculate. Okay, that how much our return is deviating from the average. For example, if your average return is 10% and we have calculated standard deviation of 4%, it means your return could be 14% also, because 10 plus 4, or return could be 10 minus 4, it could be 6% also. Right? So first we will calculate the average return. Average we have already calculated. Expected return is your average return. So then we will calculate the standard deviation, and we will see how much our return can deviate from the mean, or from the average, or from the expected value, or from the expected return. Understood? So here we go. So now I'm going to show you formula how standard deviation is calculated. So this is the formula, guys, for the standard deviation, and this is the sign for the standard deviation. Formula is what? So we have first square root, you can see. So we have a square root, and then so we have here summation. Okay, into RI. What is RI? R stands for possible rate of return. So here we go. Actually, these are possible rate of returns. So these are possible rate of return. Okay, here we have possible rate of return. Possible rate of return is 80%, and there could be a 50% loss. So first we will pick this 80%, only this figure. Okay, we'll take 80%. And what is our expected return? 28. Possible return 80, expected return 28. So I'm just trying to drive the formula here. What we will do? Under root, square root. So we'll take first 80% return, which is possible return. This possible return minus expected return, which is 28%. And then we will take here square of that, and we will multiply the probability of this 80%. The probability of this 80% is 60%. So we'll multiply. So this is one thing we got. Then we will add here again second possible return. We don't have a second possible return. We have a loss percentage. So we'll write again minus 50%. Okay, because it's a loss. And minus, this minus is in the formula. So minus what expected rate of return, which is 28%. And then we'll take square, and we will multiply with the probability of this loss. Probability of this loss is 40%. So this is the formula I'm trying to say. So this is what your possible return, minus this is your expected rate of return. Okay, this is what is their probability. Then we will take second possible return, or loss percentage, again minus 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 expected rate of return square into 40% their probability. And once we will solve, you will get standard deviation. Okay, this is the formula. So here we go. First I'm calculating the standard deviation for X corporation. Don't forget the figures. We have a possible return 80 and expected return 28. Then possible return 50 and expected return 28. And these are their probabilities. So we'll use these figures here. It is shown here. So it is shown here. So first, this is for X corporation. We have a possible return minus expected rate of return square 2. Okay, we'll take square, multiply by probability of this 80%, which is 60% given in the question. So if you will solve, this will give you one figure, plus minus 50. This is second possible return because 50% loss is there, right? Minus expected return. Okay, square into 40%. This is the probability of this 50%, right? Of this loss, the probability is 40% is there, right? So now we will solve first. If you will solve, you can use scientific calculator, but you are not allowed to use in your exam. So that is why most probably standard deviation will be given. Okay. So please remember here, if you will solve on your calculator, like 80% minus 28%, whatever answer you got, take the square of that, then multiply with the 60%. So one figure you will get here. Then you have to solve on the calculator minus 50% minus 28% square. Okay, multiply by 40%. So one figure you will get it here. So these two figure you need to plus. Then if you will plus, so you will get this, figure actually, not this, you will get this figure, 40.56%. Okay. And because you have under root of that also. If you, and please remember, so one more thing I want to tell you. So this figure which are written under the under root, like this data I'm highlighting, only data I'm highlighting, this data, this data which I'm highlighting, this is called variance also. Okay. If it means how standard deviation calculated, if I take square root of variance. So if I take square root of variance, this is called what? Standard deviation. Understood? So this inner side of the formula is called variance. If I'll take square root of that, this will become now standard deviation. Okay. So it means variance is how much? 40.56. If I'll take square root of that, so this is the standard deviation, 63.69%. Okay. 63.69%. Then guys, similar way we will calculate for y. So please make sure you are understanding. For y, how you will calculate? Let's understand the data for y first. Here we have a data for y. Again, now remember these percentages. We'll take 30% minus expected return. Then we'll take square. Okay, like I'm just driving formula. 30% minus expected return 18% square multiply by probability of 30% is how much? 70%. This is one thing. Plus. Then what? Second possible return, which is minus 10%. Possible return. Minus expected return is how much? 18%. Okay. Square. Okay. Multiply with the probability of this 10% is how much? 30%. This is variance. Variance. This is variance. If I'll take square root of that, so this will become now standard deviation. Understood? And similar way, if you will calculate the standard deviation. So for standard deviation for y is, it is calculated here, by the way. I'm showing you formula on your screen. Similar way it is calculated. So if you will calculate complete standard deviation, so answer is 18.3%. Please remember when I was telling you the concept of standard deviation, I told you if your average return is 20%, okay, then what? If standard deviation is, for example, 4, it could be 24 or 16. That was just example to just make you understand, right? But now you have to interpret these answers. And what was the interpretation which is relevant for you as a finance student? So this is the interpretation which I'm going to tell you now. If standard deviation is higher, for example, if you will consider here both investment, for one investment, standard deviation is 63.69%. Okay, here. And if you will look the standard deviation of the second, so it is 18.33%. If you will just look at the standard deviation, so here we have a higher standard deviation, here we have a lower standard deviation. It means this investment is more risky. That is why it was giving you 28% expected return, high return. And this investment is less risky. That is why it is giving you only 18% expected return. You know, 18% we calculated previously. Expected return here. You can check it here. Here 28% expected return, here 18%. Please don't mix the terminologies. You should remember what is the possible rate of return. These are possible rate of returns. So what is the expected rate of return? These are the expected rate of returns. Understood? And these are their probabilities. Oh, sorry, this figure. Understood? So if you know all these terminologies, then it will be easy for you, because otherwise you will mix. If you don't know the difference between possible rate of return and expected rate of return, then maybe you may do some mistakes. Understood? And what is the interpretation? Here is the interpretation final. If standard deviation is smaller, okay, if it is smaller, so then lower is risk is lower because volatility is lower. And if standard deviation is greater, it means risk is higher because volatility is higher. Understood? So far I told you two things mainly. What is the standard deviation and what is the expected value, right? Expected rate of return and standard deviations. These two things I have explained. Now, guys, we have here one more thing. I don't think so they will test in your exam, but just I'm explaining because it's just a one-line concept. So sometimes they if they are asking maybe theoretical concept, so what is the coefficient of variation? Coefficient of variation, it's another statistical terms. Okay, coefficient of variation is written always with the word CV. Coefficient of variation, variation is standard deviation, right? Coefficient of variation. So please remember, first you should remember what is the meaning of this. Coefficient of variation means say how much risk you are taking for each unit of return. This is the interpretation. It measures, like coefficient of variation measures the risk per unit of return. For example, if you are earning $1 as a return, okay, per unit, okay, or 1%. So how much risk you are taking for that, for this $1? This is called what? Coefficient of variation. And please remember, it is very simple. So, and first here you have to remember when it is useful. So coefficient of variation is useful when rates of return and standard deviations of two investment different. Okay. For example, as I give you example, we have an investment X and Y. For X, expected return was 28%, but standard deviation is something like 63 point some percentage, right? But for Y, expected return is 18%. Okay. But uh, standard deviation was also 18 point something percent, maybe 33%. I'm not sure. Yeah, 18.33%. Right? Now, if you look at the expected return, so then X is better because here we have a highest. But if you will look at the risk, so then Y is better because here you have a less risk. So it means here rate of returns, rate of returns and standard deviations of two investment differ. Right or wrong? So in that scenario, we can calculate coefficient of variation. What is coefficient of variation? It measures the risk per unit of return. The point is how you will calculate it. It's very simple. So for example, so this is the formula for coefficient of variation. Formula is what? We will take standard deviation. We'll keep standard deviation as a numerator. For example, 63% divided by expected rate of return, which is 28% for investment X. For investment Y, we'll take standard deviation, which is 18.33% as a numerator and divided by 18%, which is the expected rate of return. Right. So this will give you what? A risk per unit of return. So for example, so here we are calculating for X first. For X standard, what is the formula for coefficient of variation? So standard deviation divided by expected rate of return. For X, standard deviation is 63.69% divided by 28% is expected rate of return. So coefficient of variation CV is 2.275. Okay, and then Y company stock, if you are calculating for Y, standard deviation is 18.33% divided by 18%, which is the expected rate of return. So here is what? 1.018. Now please remember here, for each unit of return, here you have a less risk. Here you have a less risk. Understood? But for each unit of return, here you are taking more risk. So it means this is the safest investment. Right or wrong? Y is having better risk and return trade-off. Risk and return trade-off. It is here you are taking less risk actually for Y. Okay, so it means that is the safe investment. Understood? Now, guys, here we have interpretation of CV because what is the interpretation of this answer, right? So here we have a 2. Again, you have to look figures, higher and lower figures. So this explaining the interpretation of this coefficient of variation. So please remember, if coefficient of variation is lower, so a lower coefficient of variation indicates that investment has less risk per unit of return. If answer is lower, it means risk is lower. Same like standard deviation. If answer is lower, risk is lower. Okay. So please again, lower CV, coefficient of variation, indicates that investment has less risk per unit of return, making it more desirable because you are taking less risk. As I told you at the start, in efficient portfolio. So we have to get maximum return with the minimum risk. Right? So your risk is minimum. So then higher CV, if answer is higher, like for example, this 2.275, this is higher. Higher CV means there is more risk per unit of return. Okay, making the investment riskier. I hope so it is clear, right? So I told you now so far three things: what is expected value, what is standard deviation, and what is coefficient of variation. We have here, guys, please remember here I want to tell you something important, because I'm not saying I'm teaching you everything, but obviously those things which we don't have in CMA or at CMA level. So I'm not explaining those things, just whatever is in our syllabus, we are discussing those things only. So here we have now security risk. Like when you measure the security risk, security means, say, for example, if you have invested in A, so you are measuring the risk for investment in A. Okay, if you have a portfolio, what is portfolio risk? For example, you have investment in A also, plus B also, plus C also, plus D also. So when whatever calculations we discussed so far, whatever we have discussed, so those calculations we can use only for individual securities, that we can use to measure the risk of individual securities. So we are not using the calculation which I told you right now. So we cannot use for the whole portfolio. So we are using, okay, to quantify the risk for individual investment. But if you want to calculate the, or if you want to quantify the risk of whole portfolio, then there are different calculations. We need separate things. And here I'm just explaining the process for that, but it has long calculations. That is not in our exam. So this I'm just telling you risk and return for the entire portfolio, because I told you in our exam syllabus, so we have how to measure the risk of individual security, not of the entire portfolio. Maybe at CFA level we do these things, these kind of things. Okay. So here we go. Number one, if you are calculating the risk and return for the entire portfolio, so then usually we follow these steps, but it has formulas to do to work with. So those we are not discussing, but theoretically points I'm just explaining. First of all, if you are dealing with the entire portfolio, so first you have to calculate expected return of entire portfolio. Okay, and this expected return is calculated as the weighted average of individuals' assets return. Asset means investment. So first you have to take individuals' assets return. Then you have to again calculate the weighted average value for that. So that is called expected return for the portfolio. Then what? So you have to assess portfolio risk again by using weighted standard deviation. So I told you just standard deviation. So there is a concept of weighted standard deviation. It has different formulas. So we will use weighted standard deviations for the entire portfolio. And then we will also consider the correlations, okay, between those investments. So then step number three is, you don't need to remember this, please. I'm just saying, okay. So step number three is what? Diversify to reduce risk by combining asset with low or negative correlation. So simply, so you have to invest into different securities which are negatively correlated. Negatively correlated, if one security is going down, second should go up. So obviously loss on one side will be netted off with the gain on other side, right? So then what? So analyze risk adjusted return. Then step four is there. So there are some formulas to analyze risk adjusted return. Okay, here we are using some concept of Sharpe ratio, okay, or other risk metrics. So we don't need to remember this, but just I'm saying, okay. Then optimize what? So optimize the portfolio to balance risk and return. Then we will do, and here we use some tools like efficient frontier, these kind of tools we are using to do this. So this is not in your syllabus. I told you in our syllabus, they will just test how to quantify the risk for individual investment. For example, investment A is more risky or investment B is more risky. Understood? I hope so it is clear. Now, guys, we are discussing here this concept we also studied in the part one, correlation. Because in diversification we use correlated securities, mostly negative correlated also, right? Like if one is, for example, if one security is going up, so second, if let's say one is going down, second is going up, so loss on one side will be netted off on the gain on other side, right? So the correlation we studied in the part one under the regression analysis. I hope so you remember that. So because here just we have one paragraph that I'll explain. So correlation coefficient, this is a sign for correlation, R, right? Correlation is denoted with the R. So correlation measures, what it measures? The degree to which any two variables. Variables could be stocks, bonds, any two bonds. Okay, like for example, two stocks in a portfolio are related. So it has a range from +1 to -1. We know, for example, let's assume +1. Let's assume we have a company A here and we have a company B here. If company A price is increased, has increased, B is also increasing. And for example, if it has increased by 10%, it has also increased by 10%. Okay, or for example, if company A price is decreasing, B is also decreasing. For example, if it is decreased by 20%, it is also decreasing by 20%. So this is called perfect direct correlation. That here, prices of both stocks are moving in the same direction and the proportionate of change is also same. So this is what is called +1. Okay, so this could be the correlation. Then there is a correlation of -1 also. -1 means what? If company A stock price is going up by 10%, so B stock price might go down by 10%. Again, here both stock prices are moving in the opposite direction, but proportionate of change is same. This is called -1 correlation. Okay, or another way, for example, if company A stock prices is going down by 30%. So company B prices are increasing by 30%. So see, again, they are moving in the opposite direction. One is going down, other is going up, but proportionate of change is same. So this is called what? -1 correlation. Understood? So correlation value could be any value between +1 or -1. For example, correlation value is point 0.7. It's a plus. So what it means, if for example, company A stock price will increase by 10%, let's assume. So B will increase by zero point 0.7 of the first change. It's a plus, so this should also increase. Okay, so if company A price is increased by 10%, B will also increase, but B will increase by zero point 0.7 of this 10%. So zero point 0.7 of 10% will become 7%. It means if A price is increased by 10, so B price will increase by 7%. Another example, for example, if correlation is zero point 0.3 plus. Okay, plus again positive. So for example, if A price has increased by 20%, so B price will also increase because it's a plus. So, but it will increase by zero point 0.3 of first change, whatever answer you will get. So maybe it will be 6%. I'm not sure. So it means if A price will move by 20%, so this will increase by 20%. Understood? So when you are choosing diversification, mostly what we try to do, mostly we try to select the securities with inverse correlation, because if one security is performing well, so or performing bad, so other may perform well. Understood? But if you will choose the investments in the portfolio with positive correlation, so if one will go up, other will also go up. That's great. Every investment is making profit. But if one will go down, other will also go down. So you will get a loss on your entire investment, right? So this is what is the concept of correlation, right? I have already told you. So usually this correlation, we, as I told you, we use under the concept of what? Diversification. And I have already explained what is perfect positive correlation, which is +1, what is perfect negative correlation, which is -1, and correlation value could be any value between +1 and -1. Okay. And usually because practically we cannot maybe find +1 or -1 exact figures of correlation of two stocks or two bonds. So it means the value, mostly correlation could be 0.5 to 0.7, because our purpose is to reduce the risk, not to eliminate the risk, right? So risk elimination maybe we cannot do, but at least we can reduce being a good finance person. Understood? So this is the only theoretical concept of correlation. Okay, so correlation can be used in covariance formula, but this is not in our CMA exam, so I'm not explaining this. Because here, just let me tell you here, I can quickly tell you, because correlation we can use in the covariance. Okay, just one line concept I'll explain. So for example, so here if you will just understand this, because this is another term you can say. So correlation coefficient of two securities can be combined. Like here what you are, let's say we have investment A and investment B. Now you want to combine the risk of both investment. So for that, we can calculate covariance. So covariance or correlation coefficient of two securities can be combined with their standard deviations to arrive at their covariance. Actually, what is covariance? Here is the definition: a measure of their mutual volatility. Mutual volatility. Mutual, like for both investments simply. So for example, if you want to calculate covariance for X and Y, so what do you have to take? We have to take a correlation coefficient. Correlation means say R value. For example, R value could be 0.6. Correlation, or it could be 0.7, any value between +1 and -1. Then we will multiply with the standard deviation of the first investment, or let's assume investment X, and multiply by standard deviation of investment Y. These are assumed figures, okay? For example, we have, uh, I'm just assuming here because standard deviation of X, I'm assuming 63.37%. 63.37. And for Y, it is, let's assume, because actual previous value was different. Here it is assumed value. For example, for Y, it is 88.31%. So now what we will do, and the correlation between these two is 0.6. So what we'll do, we'll take coefficient, correlation coefficient, okay, which is 0.6, multiply by standard deviation of 1, which is 63.37%, means say 0.6337. If you will remove the percentage, multiply by standard deviation of second investment, let's say which was 8.31%, but it's written as 0.8831 if you will remove the percentage. Now, if you will multiply, this is what is called covariance of two stocks. Okay. Actually, what it measures the mutual volatility. Mutual means say volatility of both investments. Understood? So this is not in the exam. I don't think so. They will ask, but just I told you covariance formula when you combine the risk of two investments. Now, guys, this we have already covered in the last class. I told you what is risk and diversification. I already explained in the last class because in the last class we discussed types of investments risk. I told you what is systematic risk, if you remember. Okay, systematic risk. What is unsystematic risk? So the same two definitions are there. So it's just a simple, quick revision. I can give you. I cannot quote maximum number of examples because we have already covered in the previous video in more detail. So specific risk. Okay, this is also called unsystematic risk. Okay, this is also called diversifiable risk. This is also called unsystematic risk. This is also called residual risk. This is also called unique risk. Actually, the specific risk is the risk, or unsystematic risk is the risk associated with a specific investees operation, or this risk is related to specific company. For example, if company A is having some specific risk, so you can you can minimize that risk by investing in company A plus in company B plus in company C. It means through diversification this risk can be reduced. So that is called what? Specific risk. And please remember, specific risk is the risk that can be potentially eliminated by diversification. That you should not invest your entire amount into that company only. You should invest into other companies also, because loss on one side can be netted off on the other side. So that is specific risk. Okay, then I told you last time diversification. I have already told you that when you invest into different companies of different sectors just to get the average return. So then market risk. Market risk is also called systematic risk. I have explained in the last video. It is also called undiversifiable risk. That this risk you cannot diversify away. You cannot diversify away. Okay, uh, by having diversified portfolio. For example, if there is a war, let's say we have invested in company A, B, See, it means you have diversification. You have invested into different companies, but there is a war. If there is a war, it will reduce the price of company A also, B also, C also. It means this war is the source of a systematic risk which cannot be reduced even you are holding diversified investment. Understood? So that is the market risk actually. So market risk is what? Undiversifiable risk or systematic risk. So it is the risk of the stock market as a whole, not of a specific company, right? Because previous risk was relevant only specific company. And in previous risk, I told you we can reduce by investing into other companies also. But here the market risk, this risk of the stock, okay, stock market as a whole. And some conditions in national economy affects all business. As I give you example, war will affect all businesses. So which is why equity prices so often move together, like all may go down, for example, due to war or economic recession. So I told you diversifiable risk is called specific risk or unsystematic risk. Undiversifiable risk is called what? Market risk. Understood? Or systematic risk. Now, guys, we have here another small concept of beta. So let me quickly explain this. So please remember what is the first beta. So actually beta, actually it's a figure, it's a value. So first let me simple give you idea. So some investments, they may have a beta of 1. Some individual securities I'm talking about. For example, company A's stock is having beta 1 because beta calculation is not in our syllabus. Again, it's a statistical calculation. But being a finance student, you should know what is the beta. So beta value could be 1, exactly 1. It could be exactly 1. Okay, or it could be greater than 1, or it could be less than 1. So being a finance student, so you have to understand these three terminologies. Okay, so first I'm explaining what is the beta. Then I'll tell you what is if beta is equal 1, and what is the meaning if the beta is less than 1, and what is the meaning if the beta is greater than 1. So here we go. Please remember, beta is also called beta coefficient. Okay, this is the sign for beta. Okay, so here we go. Actually, beta is the best measure, like what we measure through beta. Obviously, we measure the risk, but we measure the risk of an individual security as compared to the market. As compared to the market. So we actually what we are doing, so we are measuring the risk of individuals. Let's assume this is the individual security. Let's assume this is the stock of company A. And here we have a market. Okay, let's assume this is the stock of company A. And market, I'm assuming, for example, it is your S&P. Okay, S&P 500. S&P 500 is a term in the stock exchange, guys. I believe this is Standard and Poor's 500. So this S&P 500 means say here we have a stocks of top 500 companies. So let's do we are comparing the stock price movement of the company A with the stock price movement of the all these 500 companies. So let's assume this is the market. Okay, this is the market. For example, now if beta is 1, if beta is exactly 1, it, you know what it means? If beta is exactly 1, it means if, for example, if stock price, if the market is going up by 10%, so this company stock price will also go up by 10%. Because it's equal 1. Equal 1 means say the variation which we are having in the market, same variation you will get into the individual security, into that security in which you are investing. Okay. For example, if stock prices, if market is going down, let's say by 5%. So your company, your individual security will also go down by 5%. See, so moving in the same direction, but proportionate of change is also same. Understood? So this is what is meaning of beta 1. So, but what if the beta is greater than 1? For example, here again we have a company A and here we have a S&P 500. Let's assume I'm assuming this is market. And beta is greater than 1. For example, 1 greater than 1 means what? Let's assume beta is 1.5 because it's a greater than 1, right? Greater than 1 mean to say I'm assuming beta is 1.5. Okay, beta is 1.5. So what it means? It means if market will go up by 10%, so your company stock price will increase by 1.5, 1.5 times of this 10%. It means maybe it is 15%. A similar way, if the market is going down by 10%, so your company price will go down by 1.5 of this 10%. Okay, maybe if this will go by 10%, this will go down by 15%. And downside is always our risk, right? Not the upper side, upper side. Downside is our risk. So this is what is the meaning of greater than 1. So now let's assume if beta is less than 1. For example, if beta is less than 1, for example, answer is 0.8. Let's say this is less than 1, right? So again, we have a company A stock prices and here we have a market. For example, if market is going up by 10%, okay, so company A price will increase by 8.8 into 10%, like means say 8%. Like this beta you will multiply with the market. But if your market is going down by 10%, so obviously your stock price will go down by 8% because 0.8 of this 10. Okay, this will be 8%. Understood? So now one more thing. One more thing. I'm explaining one more thing now. For example, if beta is 1 of any individual security, let's assume company A and market. So what it means? It means your company A stock price is equally volatile as compared to the market. Company A stock price is equally risky as compared to the market. Equally. Both are equally risky. But if beta is greater than 1, if it means here risk for A is greater than market because beta represents risk. If less than 1, here what? Here risk of individual security is equal to the risk of the market. Both risks are equal. But if it's greater than 1, it means this individual security is more risky than market. If less than 1, it means this individual security is less risky than market. Less risky than market. Risk is less than market. Understood? So these are the interpretations. Just you have to understand the interpretations. So I have already explained these things. What is beta? So you can just go through. You can just later on pass the screen and go through here. What is written here? So again, I told you if beta is less than 1, it means less volatile, less risky. If beta is greater than 1, it means more volatile, more risky. If beta is exactly 1, it means your individual security is exactly risky equal to the market risk. Okay, or equal to the market. It's risky equal to the market. So guys, please remember here, uh, beta, when you actually calculations are not there for the beta, just interpretation, you need to know what are the interpretations of the beta. Okay, so figures will be given and I'll tell you the use of beta in CAPM theory also. So please remember, so because beta is the risk, right? Beta factor or beta coefficient is measuring the risk of the investment, right? And the risk is based on number of, for example, company A. You want to measure the risk of company A. Okay. So obviously company A risk is dependent upon various factors. Company A uh, risk can be affected through the debt equity ratio. For example, if company is taking more debt, like it is more having more financial leverage, so it means it will become more risky. If their debt equity ratio answer is less, it means it is less risky. So it means debt equity ratio may affect the risk of the company, right? Then operating leverage can also affect the risk of the company. Operating leverage means a ratio of fixed cost to variable cost. Like if company is having higher amount of fixed cost, right? So it is more risky, so beta will be higher. If company is having lower fixed cost as compared to variable cost, it means company is less risky, so beta will be less. And beta calculation will also be affected by the characteristics of the industry. Actually, there is the calculations for beta, but not in our syllabus. So just we have to understand what is the interpretation of beta. So these 2 points I remember. Important. If beta is less than 1, it means if the beta of the beta of the stock in which you are investing, if the beta of that stock is less than 1, it means that stock is less risky as compared to the market. If the beta of that stock is more than 1, it means that stock is more risky as compared to the market. Okay, so this is what you have to remember. Less than 1 means a less risk. More than 1, if beta is more than 1, it means more risky. And this is things it's written that beta is calculated at beta is based on number of different risk factors. Risk factors could be debt to equity ratio of the company, operating leverages, characteristics of the industries, etc. Here we have a CAPM theory. Please remember, guys, this is called capital asset pricing model. So first you should know what is the use of this model. Actually, this is a one equation we will discuss. So the use is that if you want to calculate your expected rate of return, okay, for the equity investor means those people who are investing into the common stocks or the ordinary shares. So how do we calculate the expected rate of return? That how much return we should expect from the company or how much return company should pay to the equity holders. So for that, we always use what capital asset pricing model equation. Okay. So it means what's the use? Like how much, if you are an equity investor, how much return we can expect for the company based on the risk. Understood? Or how much company should pay to the investors based on the risk. So for that, we always use capital asset pricing model. Understood? So here, please, it's a kind of definition is here. They're telling you in order to measure, okay, how a particular security contribute to the risk and return of diversified portfolio, investors can use the capital asset pricing model. That obviously, as I told you, if you're taking more risk, so you will expect more return. So this CAPM will give you a high rate of return if you're taking more risk. But if you're taking less risk, it means you should expect less return. So CAPM will give you less answer for the less risk. Understood? So please remember CAPM quantifies what? Required return on equity security. As I told you, this is the use of CAPM. Actually, we are calculating expected rate of return for equity holders, for equity investors. Understood? Which is purely based on the risk calculation. If you're taking high risk, high return you should expect. If you're taking less risk, less return you should expect. So here we have a CAPM formula. I'm just going to explain. So what is the CAPM formula? So let me explain the formula and then this theory will automatically be covered with the formula. So this is how we will calculate required rate of return for equity holders. So we always take a risk-free rate of return because when you invest into the stock, so first you should expect the risk-free rate. For example, risk-free rate is what? The rate of return which is maybe offered by the government on the government securities, maybe the government treasury bills, right? Government is issuing treasury bills. So whatever the return is offered by government, that is risk-free rate. For example, treasury bills are government securities. They are offering, for example, 5% return. So this is actually the risk-free rate of return. This is called risk-free rate of return. Why? Because this is the safest investment because there is very less chance that government will default, right? So that is called risk-free rate of return. So now think when you invest into the companies, so you are taking risk or not? Yes, we are taking risk because companies are always riskier than government securities. Companies securities are always riskier than government securities. It means when you invest into the companies, so first the return which I want, that is the risk free, and then I want to add my risk premium here. Risk premium means the something extra. Okay, because I'm taking extra risk by investing into the company. So first, I want risk-free return. Then I'll add here some kind of risk premium, some extra return because I'm taking risk by investing into the companies. And then I will get what? My required rate of return. The required rate of return. This is what is the idea of that. Now here we go. So that is why I told you how we will calculate required rate of return. So we'll take risk-free rate. First, we'll take risk-free rate plus beta of that individual security in which you are investing. So this beta you have to multiply with RM minus RF. So what is RM? RM means a return on market. Return on market. So return on market, what is return on market? Okay. Return on market means say what on average market is paying to the investor. For example, simply you can say this way also in simple words, we can say what a market, for example, if market beta is 1 or if company beta is 1. Okay. So how much, let's say there is a company whose beta is 1, how much that company is paying or how much on average we are getting on the market if beta is equal to 1. So for example, that is called what? Return on the market. Minus RF is what? RF is risk-free rate of return. So I'm just giving you example here now and then you will understand the equation. So what is the example? For example, on average we have a return on market is 10%. Return on market. Okay, we are assuming the market beta is 1, for example, and the average return on the market is 10%. Minus RF, risk-free rate is 5%. So 10 minus 5, RM minus RF, 10 minus 5 equals 5. It means, so this 5% premium is given by the market. Okay, if market beta is 1. Okay, or this is the over and above or excess premium is paid by the market over the risk-free rate, right? That is 5%. This is the excess paid by the market over the risk-free because RM minus RF. Now this risk-free, this excess, okay, this is also called market risk premium, this 5%. Like simply RM minus RF is called market risk premium. That how much market is paying over and above the risk-free rate. That is called market risk premium. Okay. So for example, market is paying 5% extra over and above the risk-free 5%. Okay. Now this 5% you will multiply with the beta. Beta of the company. For example, beta of the company in which you are investing, that is 1.2. So now it means how much we should expect. We should expect 1.2 times of this 5% because our company is more risky in which we are investing. So I want 1.2 times of this premium. Okay. For example, if the securities in which I am investing, that beta is, let's assume, zero point 0.8, beta is zero point 0.8. So now it means if market risk premium is 5%, but the security in which I am investing, that is less risky, zero point 0.8. Now how much return I should expect from this company in which I am investing? I take zero point 0.8 of 5%. Right? This is how beta will change your premium, right? Risk will change your premium. If beta is greater than 1, so you will take 5% into 1.2, for example. If beta is less than 1, you will take 5% of 5% times zero point 0.8. Let's remember this beta is zero point 0.8. Then you will add into risk-free rate. So this will give you required rate of return. So here we go. I'm just going to tell you here a small example. For example, let's assume an investor is, now you will understand, an investor is considering the purchase of a stock, like you are investing into specific company, and that company's beta value is 1.2. It means that company is more risky. Treasury bills, means a risk-free rate, are currently paying 8.6%. This is the risk-free rate. And expected average return on the market is 10.1%. This is what is the return on the market. So now you will apply the CAPM formula. So required rate of return equals risk-free rate RF. Okay, into beta, sorry, not into, it's plus beta into RM, which is market return, return on market, minus RF. So now just put the values. So risk-free rate of return is 8.6%. So I can write 0.086 plus beta is how much? Beta of the investment in which I'm investing, that is 1.2 into RM. RM is what? Return on market. Return on market is how much? 10.1%. So I can say 0.101 minus. Okay. Sorry. Sorry. 0.101 minus risk-free rate is how much? 0.086. Okay. Now if I'll take the difference here, which is called market risk premium. Market risk premium. Okay. So 10.1 minus 8.6. So this is what is the return which is excess paid by market over the risk free. So this return I'll multiply with the beta. So I'll get how much return I want, or how much risk premium I want from this investment which I'm making into the specific company. Okay. Then I'll add with the risk free rate. So this once I'll solve, so I'll get 10.4%. So here percentages are not removed. Risk-free rate is 8.6 plus beta is 1.2. Required return on market is 10.1 minus risk-free rate is 8.6. So if you will solve, this is market risk premium multiply by beta of the individual security in which you are investing. So you will get, if you will multiply this area from here to here. So this is what is the risk premium which you want from your investment. Then add with the risk-free rate. So this is how you will get required rate of return. Okay, this is CAPM formula. And here we have now, there are two practical problems with this CAPM equation. Please remember, first of all, this is called single period model. We can use only for 1 year. We cannot use for the investment of 10 years or 15 years. So the reason is that the required rate of return we can project only for 1 year. For 1 year, because now risk-free rate is 5%, for example. Next year it may be different. Next year it may be different because risk-free rate may change due to inflations, etc. So that's why it's single period model. Understood? Second thing, it is hard to estimate the risk-free rate of return on projects under different economic environment because every country is having different inflation rate, right? And it can be used only for single period. Okay, guys, I hope so it is clear. If you have any question, you can ask.